Okay, today we will learn topic 9 about bank security and capital adequacy. Okay, so what is the meaning of bank security? Okay, most of the student when they talk about bank security, basically they're thinking about cyber threat. Okay, but that is different meanings. Okay, when in bank operations, bank security means how bank can secure their stakeholder, especially when they manage their asset liability, they manage their capitals. Okay, so that's why it relates to the capitals, because anything happen to the assets, still can the capital can support. Okay, to ensure the security of the stakeholder of the banks in good conditions. Okay. Okay, in this chapter, the most important you need to know and to understand uh, who are the stakeholder of the banks that the banks need to protect to ensure they are in the secure conditions. And then what is the purpose of capitals? What are type of capitals? How these different type of capitals are used by the banks. Okay. When we talk about bank capital just now, we relate with the security, right? Bank security. This security mean to who? For example, to protect who can get protected when the bank security is intact. Okay, who will bear the loss, or who will feel not secure when bank management have problems or bank bankrupts. Okay, so this is actually related to the stakeholder of the bank. Basically, we highlight four main stakeholder of the bank, which is regulatory of body, regulatory body of banks, supervisor of the banks, borrowers, depositor, and also publics. Okay, so how bank capitals are important to the regulator. Okay, uh, this is because regulator or supervisor of the banks, they are when they supervise bank, they need to ensure that the bank can sustain in longer periods. Okay, this is to ensure that bank can sustain in longer periods, to ensure it can uh, sustain also in the financial system. Okay, the importance of the bank to sustain in longer periods, because it's to ensure the balance or the bank or financial institutions exist in financial system, so they can help financial markets. Okay, if you remember that financial system of Malaysia, financial system in other country also, they consist of two parts: financial market and financial institution. So both of these parts need to exist together. Okay, due to that, the regulator need to ensure that banks can sustain in longer periods. Okay, because if the bank, especially banks in Malaysia, bank in other country, they cannot sustain in longer period, it will affect the banking system. When the banking system collapse, it also will affect the financial system of a country. Okay, because banking system usually the funder to the financial markets, the funder of funds. Okay, so that's why it's important uh, the capital to ensure bank can sustain in longer period. So that's to ensure the banking system in good condition and continuously to ensure the financial system of the country established and can grow. Okay, to generate economics, to generate income to the countries. Okay. Okay, the next, why capitals, bank security. We measure bank security by the establishment of the bank capital. Okay, why bank security is important to depositor. Okay, the second stakeholder is depositor, because depositor put their money in the bank, in saving account, fixed deposits, okay, either household depositor or business depositor. They put money in the bank, so they need to, or they will withdraw the money anytime. So when they withdraw the money, they need bank need to ensure the depositor can withdraw the money anytime. Okay, the bank need to ensure the can fulfill the withdrawal demand by depositor anytime. Okay, so the importance of adequate capitals, okay, to the depositor to ensure the bank can fulfill their demand of withdrawal anytime. Okay, so if bank can fulfill their withdrawal demand at any times, okay, the bank has a good security, make the depositor happy, secure to put money in the banks. Because if depositor feel the bank is not secure, meaning they're not confident with the bank, okay, so they will not put money in the banks. Okay, okay, in terms of borrower, okay, bank security important to the borrower, okay, because if the borrower, which is customer of the bank, okay, they want to borrow money from the bank need to ensure that they have money to lend the money to the borrower. So this can maintain the relationship between borrower and the banks. Okay, so if they can maintain this, it can ensure the bank can continue their operatings, which is lending activities, and can generate income. Okay, previously there is an incident during the financial crisis. During that times, that less concern on the capital of the banks. Okay, so during that financial crisis, after the financial crisis, there is a lot of banks have liquidity problem. They do not have funds. Even they cannot take their fund from the capital because they don't have enough capital. They do not have, a bank do not have adequate capitals. Okay, so due to these periods of crisis, bank cannot lend their money to the borrower. Okay, because they don't have funds. Even they cannot take fund from the capitals. Okay, so this makes the borrower, the potential customer, not happy with the banks. So meaning they are insecure, especially because the bank have high NPLs. Okay, so due to the high NPL, we reduce the bank funds. Bank cannot, bank did not have any money to do lending activities with other borrower. Okay, okay, the last stakeholder of the bank is public, general public. Even though you are not the customer of the bank, or you are not the borrower of the bank, potential borrower, but the bank security also is important to the publics. Why? Because to show their image. Okay, because if bank did not have enough security, did not have a good security, it will portray bad image to the public. So it will cannot attract the potential customer, the publics. Okay, public do not believe on the banks. Okay, so if the public did not believe on the bank, it also can harm the banking system. Okay, for example, last times when there is a cyber security issue, a bank did not have money to compensate the deposited, okay, money. Okay, that's also make the public did not secure to put money in that banks. Okay, not only on that bank, even in the banks, other bank, because they feel, for example, like online transactions. Okay, if online transactions affects, uh, there is also can not only affect the image of the bank that have online transaction security, but all the bank that have online banking system. Okay, meaning that public did not confident with the banks, so it can affect the confidence of the public to the banking system. So if this not tackles in the short period, continuously happen, it can affect the banking system and affect the financial system. So it's very important, okay, to ensure that the stakeholder, for example, like the supervisor, depositor, borrower and publics, okay, feel secure when they are dealing with the banks. Okay. Okay, one way to ensure the security of banks, okay, security bank have adequate security. They measure using capital of the bank. Okay, to ensure the bank security, the measurement are based on the capital of the bank, whether the bank have adequate capital to cover any losses, adequate capital to cover any issue. Okay, so what is the capital of the bank? In corporation, we know the capital of the bank is equivalent to asset minus liability, meaning the asset of the corporations financed by capital and liabilities. Okay, so there is a slightly difference. Okay, even though the concept is similar in the banks, in the balance sheet, the asset equivalent to liability plus um, equity, okay, which is capital. But capital of the bank, they have slightly different definition. Okay, for examples, okay, uh, the bank capital in the banks, as you can see, the asset minus the liability and minus certain types of debt and reserves stipulated by the regulatory body. Okay, liabilities and minus certain type of meaning debts. Okay, meaning debts. Some type of the debts and reserve are also considered as capital of the banks. Okay, so debt and reserve are included in the bank capital to ensure that bank have adequate capital funds. Okay, so if not, this is the normal one. Okay, capitals equivalent to asset minus liability, but liability excluded debt and what we call that, reserve. Okay, so when that is the definitions, okay, so we define bank capital under two categories, okay, because it's including debts, okay, certain type of debt and also reserve including in bank capital. This is for the sake to fulfill the uh, um, requirement of the regulator, requirement of the central banks. Okay, they need to also consider debt and reserve as a capital. So because of that, they have two type of their capital separate to two types, tier 1 and tier 2. Okay, the tier 1 basically is basic capital or the main capital. Tier 2 is additional capitals or secondary capitals. Okay, so what is tier 1 capitals? Okay, okay, this one basically this is a simple capitals in the banks, okay, in the bank operations. You can see the square points. This is all under type 1 security, type 1 capitals. Okay, okay, this one under, okay, type 1 capitals. Okay, another two, okay, this one and this one is tier 2. Okay, so you can see the tier 1 capital is the main capital, which is consists of common stock or ordinary share, preference stocks, okay, stock or share similar, okay, surplus, okay, and then undivided profit, contingency reserve, and loan loss reserve. Ordinary share, I believe you know what is ordinary share and the difference with preference stocks. Okay, both of it are share. Okay, I hope you know because you already learned in the financial management and corporate class. Okay, so what is loan loss reserve? Okay, we talk about this one. Okay, loan loss reserve meanings there is this type of reserve are used to absorb the loss arising from the non-repayment or bad debts, bad loans. Okay, for example, if this reserve to cover or to absorb loss from the non-performing loans. Okay, when people did not pay, when the borrower did not pay, at least they can use this reserve and put back in the assets. Okay, or use this reserve to lend the money to the potential borrower. Okay, that is the loan loss reserve. Okay. So what else? How about undivided profit? Undivided profit equivalents to the retained earning. What is retained earning? Net income that did not distribute to the bank shareholder as a dividend. So some of net income they will retain in the bank to reinvest. So that's why we call undivided profits. Okay. And then we also have surplus. What is surplus? What is surplus? Okay, surplus basically is the difference of the share price and the share value. Okay, for example, like bank have their own share, and then what is the market now? Maybe when they issue the share 3 ringgit, at the market now is 10 ringgit, so the difference is surplus. Okay. So whether they want to use that, okay, the profit, the surplus for their capital when they have any problem or any short of liquidity. Okay, and then another reserve under core 1 capitals or tier 1 capital is contingency reserve. What is contingency reserve? Okay, this reserve actually for the contingencies issue such as legal action or undeclared dividends. Okay, payment for undeclared dividend. For example, your client or bank customer take legal actions. Okay, so when they want to dealing with that customer, go to the court or legal action, they can take from contingency reserve. Or if the bank want to take legal action to the non-performing loan or to the borrower that did not pay, so they also can use this contingency reserve to pay the fees of legal fees. Okay. Or another example is to pay for the undeclared dividend. For example, maybe they are forget to declare dividend, so they need to pay. They can take from this one. Okay. And that is the core capital of the bank. Okay, the main capitals. Usually when we talk about capital, this one. Additional capital of the bank, tier 2. This is what different with the corporation. Okay, in corporation, both of it, debenture and convertible security, is under liability. But for the banks, they also consider this part, okay, tier 2, as additional capital. So what is debenture class? Debenture is unsecured long-term bond or unsecured long-term debt. Meaning the bank issue debenture, okay, issue long-term bond actually without any collateral, without any pledge of asset. Okay, so if anything happen, they cannot pay the bondholder. Okay, bondholder also cannot claim anything because bank issue the debt without any collateral. So if bank bankrupt, the bondholder cannot claim any asset of the banks. Okay, because no collaterals. So the issue of the debenture must pay interest. Similar concept like bond. They have fixed interest need to pay to the bondholder like coupon payments. Okay. So sometimes most of the time when the bank the issue of the debenture or the issue of the bond, they cannot fulfill the obligation to pay the interest to the bondholder on time. It can affect the liquidate, okay, or defaults. The bank will default because they not or cannot afford to pay the coupon rate. to pay the interest to the bondholder. Okay, so debenture is another source of capital when bank issue bond. Okay, convertible security also is a type of long-term debt instrument, bond. Okay, like convertible bonds. Okay, when come to maturity, the bondholder become shareholder. Okay, this is both of these are long-term debt instrument or long-term bond. Okay, one debenture, one is convertible security. So the most important for the capitals, okay, the type of capital, what you need to know is what is the advantages and disadvantages of each capitals. Okay, for example, between common stock and retained earning. Okay, between common stock and retained earning, which one is more preferable for bank to use as a capital? Okay, between common stock and undivided profits. Okay, the answer is you need to understand the features of each capital so you can answer. The answer is undivided profit. Why? Because the cost of capital from undivided profit, which is retained earning, are lower cost compared to the cost of capital that come from the common stock. Common stock, bank need to issue new stock. There is a flotation cost. There is other administration cost involved. Okay, but for undivided profit, okay, the fund is in the bank management already. It's retained in the bank. So the cost of capital using retained earning are lower. So bank prefer to use retained earning, okay, for their capitals. Okay, however, there is also disadvantages of retained earning. Okay, for example, the shareholder of the bank will not happy if the bank hold or retain too many net income in the company, or if the bank did not distribute dividends to the shareholder and retain the company to reinvest back. Okay, so if the shareholder are not happy with that, because bank want to use retained earning, it can affect the share price of the bank in the markets. Okay, so you need to think when there is a question asked about which one between this type of capital are preferred to the banks. Okay, so you need to know the features so you can make your choice and then justify. Okay, for example, debenture and compare debenture and preferred stocks. Okay, which one do you think bank more prefer, preferred stock or debenture? Okay, must be bank prefer preferred stocks. Okay, because debenture, bank are obligation to pay the interest every year or every 6 months, is obliged, compulsory. Preferred stocks, if bank use capital by issuing preferred stocks, even though preferred stocks are compulsory to pay dividend, but bank can hold the dividends. When they only have money, they can pay dividends, or bank can bring forward, accumulate the dividends and pay dividend in the future if they currently not did not have any profits or did not have any funds. But if the bank raise capital based on debenture or convertible security, either bank have profit or bank getting loss that year, they need to pay the interest to the debenture holder or to the convertible bond holder. Okay, so after understanding bank security, bank capital, and there is a different type of capital. So when bank make decision, the how many portion different type of capital, meaning that capital very important to the bank to ensure the bank security. So why capital's importance to the banks? What is the function of capital? So why we always portray the bank security based on the capital, because of the operational functions, protection functions, and also supervision functions. Okay, the bank capital is important to ensure that bank can operate their business. Of course, bank need a funds from capitals to do their activities. Okay. Okay, for example, bank need capitals to buy the fixed assets, to buy the stationery, and they need funds. Okay, they need funds. Okay, to lend the money. Okay, to lend the money to the borrower. Okay, because the main activity of the bank is lending activities. Okay, so capital is important to ensure that bank can lend the money or have fund. Okay, adequate funds to lend to the borrower. Okay, and then that's why they need to ensure they have adequate level of capital to ensure they can sustain. Okay, in the longer periods. Okay, capital also important for the bank. Maybe they can share capital with other branch. Okay, so to ensure they have long-term fund, because you know that main fund is come from the deposit money. But if they do not have enough fund for long-term capitals, okay, did not have enough funds for the long-term loan, they can take fund from the capital, because most of the capital of the bank are long-term fund. Okay, because share, okay, debenture are long-term bonds. Okay, that capital is long-term, so they can finance long-term loans. Okay, to generate income. Okay, that is the function, number one function of capital. Number two, function of capital as protection. Protection to who? Okay, as you realize just now, one of the some capital about reserves. Okay, and then debts. Okay, capital is very important to protect banks. Okay, bank operation. For example, to protect when the bank have loss, especially when the bank have high NPL. Okay, when they have high NPL, they can use the capitals. Okay, to make sure they have adequate level of capital that required by supervisor of the banks. Okay, so the adequate level of capital can ensure the bank can absorb the loss of non-performing loan. Okay, so that they are have ready, or they have a ready funds and can fulfill withdrawal demand anytime. So you can see it can protect the bank management, protect the depositor without lost the money, even though the bank have high NPL. Okay, so this is very important to ensure the general public, okay, to portray that bank ability to the general public to protect a good image. Okay, so that's why one of the bank capital is important, because to protect, okay, operate for operation, for protects the stakeholder that I mentioned the four. Okay, and lastly for the supervision purpose. Okay, from time to time central banks or supervisor of the bank, they will supervise. They have a system, okay, to supervise, to check on the all the financial institution under central banks. Okay, whether they fulfill the requirement or not. Okay, because the bank regulator or central banks, okay, in Malaysia, they have certain standard of capitals or liquidity to fulfill, to ensure that bank can operate. Okay, for banks or financial institutions to operate in Malaysia, they need to fulfill the capital adequacy ratio, for example, the liquidity ratio, for example. So this is very important, because this ratio or this measurement, uh, that bank will check, investigate from time to time to ensure that bank can sustain in longer periods. Okay, to protect, also to protect the customer, especially depositor money, to ensure bank can sustain, so that the depositor not lost their money. Okay, so one of the requirement is capital adequacy ratio. So capital very important to the bank so that they can fulfill the requirement of capital adequacy ratio. There is a ratio to determine whether the bank at the good level of capital or not. Okay. Uh, Usually most of the bank has higher than that. The more capitals adequacy ratio CAR, okay, the higher they can lend the money to the publics. Okay, meaning they are established. So to ensure the bank have a adequate level of capital so that they have a good security to the stakeholder. Okay, what is the meaning of adequate capital to the banks? Okay, how much is capital adequate to a bank? Okay, so basically the level of capital adequacy by the bank are different. Depends on how much they want to lend the money. Okay, so the general meaning is the level of capital that could allow bank to absorb losses and at the same time sufficient to maintain their operations. Okay, so that they can sustain in longer periods. Okay, so okay, capital adequate meaning they can absorb losses from the non-performing loan, from the risk defaults, okay, from the credit risk due to the customer did not or borrower did not pay their loans, okay. And the same time, they also have sufficient, even though the customer did not pay, which the borrower did not pay the money, the loans, but banks still have fund to maintain their operation, which is to lend the money to other borrower. Okay, so this meaning bank have adequate capital. Okay, even though the borrower did not pay the loans, but bank still can maintain their operation, which is still can lend the money to other borrower. Okay, because they can generate another income from the other borrower. So this is general meanings of the adequate capital of a bank. Okay, so to achieve this adequate level of capitals, okay, basically bank need to balance the interest between the among the stakeholder. Who is the stakeholder of the bank? The depositor, the shareholder, creditor, borrower. Okay. For example, they need to protect to ensure the money adequate because they need to protect the depositor to ensure depositor can withdraw money anytime. Okay, and then they can pay the creditor when the debt is due. Okay, because you know bank also the source of fund for the bank also come from the borrowing, right? So the main sources is depositor. So they need to fulfill the withdrawal demand by depositor. And then also source from the borrowings. Okay, bank have money to pay back their loans to other financial institutions, to pay back their loans from other organizations. Okay, and then they also at the same times, okay, they need to balance to ensure that public confidence with their uh, banks. Okay, the capital is very important. Okay, and maintain operations. Okay, balance interest between depositor and creditor. Bank can bank can fulfill withdrawal demand or pay back their debts anytime. And then bank also can lend the money to the borrower anytime. Okay, and to the shareholder to ensure bank can uh, perform well, so they can share the return with shareholder with the dividends. Okay, and to maintain the public image, so the bank can maintain their image and increase their share value, share price. Okay, so this is how bank needs to balance all these interests. Interest of depositor what? Fulfill the withdrawal demand. Interest of shareholder, increase their share value, maximize their wealth, increase their share price. The interest of creditor, to pay on time whatever bank borrow to the creditor. Interest of borrower, to ensure that bank can grant loans when they want. Okay, so bank needs to ensure their capital can fulfill this interest of the stakeholder. Okay, to ensure to ensure the bank can balance the interest of these four stakeholder, what bank need to do is to trade off between the risk and return of the capital. Every capital have the risk and return. For example, what is the risk um, when bank get capital from the debt? Okay, when bank uh, gain capitals from the debts, the risk is there is potential bank cannot pay the interest. There is potential bank cannot pay the debt in the future. So that the risk of the capital. Okay, but the debt also have returns. Debt is the lower sources of the capital because the interest they paid to the bondholder, okay, the interest they paid to the long-term debts can be tax deductible. Okay, do you still remember the net income? Okay, after we minus that, we minus interest, we minus tax, then we get net income. That interest are tax deductibles. That interest are interest that bank pay to the uh, creditors. Okay, so every capitals they have risk and also return. Every capital there is advantages and disadvantages. So bank need to balance these advantages and disadvantages so that they can maintain their profitability and also maintain their liquidity. Okay, balance between liquidity and profitability. Okay, reduce the risk and maximize their profits. Okay, so any option of capitals, it will affect the risk. Okay, so adequate capital is important to ensure bank can reduce their risk. So as we mentioned, every capital involve risk component. Okay, so what is the risk components that always we talk related to the capital? We have several of risks. Okay, we have discussed on the credit risk already, which is related to the uh, borrower did not pay on time. Okay, default risk. Okay, and then bank will affect their liquidity. Okay, so liquidity means bank did not have enough funds. Okay, so when bank enough lot have enough funds, okay, it can affect liquidity of the bank, higher liquidity risk. Okay, and then interest rate risk. Okay, uh, you need to consider also when you uh, try to gain capitals, when bank try to gain capitals or for their funds. Okay, they need also to consider the interest rate risk. Okay, which okay, because this capital will be affected by interest rate. The higher the interest rate will affect the cost of capitals. And then okay, bank need capital also to reduce their operational risk. What is the operational risk? For example, the risk, okay, bank will have getting loss or lower income due to the not managed well. For example, not cost efficiency, uh, not cost effectively, sorry. For example, they open many branch but most of the branch are not performs. Okay, so that is operational risk. Okay, useless of capital. Okay, and then exchange rate risk. Okay, this one related to the exchange rates. Okay, banks need capital to ensure they can cover the exchange rate risk. For example, suddenly they borrow money from the euro currency, suddenly national ringgit depreciate, so at least they can use these capitals to cover the depreciation of national ringgit to pay the high amounts due uh, to the lender due to the changes of the currency. Okay, And then they also need to the bank also need capital because uh, to reduce the crime risk. For example, when cybersecurity, for example, right? Cybersecurity uh, bank uh, affect bank image. So they need to reduce the cybersecurity. For example, hire more system, more better system. Okay, so this also need money. So which money come? They can take from the capital. So capital is important to reduce all this type of risk. Okay, where is more risk? Okay, but we focus on this type of risk. Okay, maybe sometime my question ask explain why what risk can be controlled or reduced by having adequate capitals. Okay, so your answer you can mention about adequate capital can reduce the credit risk, liquidity risk, crime risk, explain. Okay. Okay, we have discussed about this previous slides. Okay, this slide talk about the operational risk. Okay, how bank can reduce the operational risk. So, what actually capital adequate for a bank? How bank measure whether the capital is adequate or not for their banks? Okay, so usually that the bench of mark is they follow the capital requirements or capital regulation setting by the Bank Negara Malaysia. Okay, the capital requirements. Okay, so why actually the BNM or central bank supervisor of the banks, okay, they have capital requirements. Okay, because they want to limit the risk of bank failure. Because when bank system fail, it will affect the financial system of country. It will also affect the economic growth of the country. Okay, and uh, the capital requirement also important because it can portray a good image to the publics. Okay, because if the bank operate their business without less capitals, how they want to generate profits, how they want to sustain in longer periods. And again, the reason of capitals, okay, to limit their losses. For example, why supervisor of the banks have a capital requirement, so that's to limit the losses of the banks, okay, especially when economic condition change and then there is a lot of NPLs. So at least when they fulfill the capital requirement by or setting by the central bank, meaning that they have adequate level of capital to absorb the loss. Okay, so how much capital is adequate for a bank? Okay, it depends on the risk of each bank. The higher the risk of the banks, they should have more capitals. Okay, uh, how what do you mean by higher risk? For example, Maybank, they lend the money a lot, okay, because Maybank is the biggest bank, commercial bank, local commercial bank in Malaysia, so they have a lot of fund, so they lend the money a lot, okay. So when they lend the money a lot to the public, to the borrower, meaning they have potential having higher credit risk when the borrower did not pay, right? Okay, so if they know when they lend the money more, meaning the risk for NPL higher, they need to keep more capitals. Okay, so that is based on risk. Okay, so basically when bank have low quality asset, meanings the loan uh, in their balance sheets. Okay, quality of loans, meaning there is potential high NPLs. The customer of the borrower pay late. Okay, this one bank need to have more capitals. Okay, and a bank which have limited access to liquid fund. Okay, meaning they do not have of T-bills or their deposit. Okay, they cannot borrow short-term fund immediately. Okay, so this type of bank they need to have more capitals because If they cannot borrow money from others to access liquid fund, or they did not have enough T-bills, enough short-term security to liquidate, okay, they need to keep more capital. So when they need capitals, when they need fund to fulfill withdrawal demands, they can get from the extra capital that they have. Okay. Okay. Bank also need to maintain their capital based on the mismatch of their asset and liability. The more capital needed if the bank has severe mismatch of asset and liability. For example, bank asset of the bank, which is loan. When we talk about asset, we focus more on loans because the main asset of the bank is loan. If bank have a lot of long-term loans, but their liability, meaning the sources of fund, are short-term, right? Bank should have more capital, because if suddenly the liability, the short-term liability, they need to pay the short-term liability, and they cannot get money from the asset because the asset are long-term assets. They can use money from the capitals, okay, to pay the obligation on the short-term liability. Okay, so if there is severe mismatch between asset and liability, loan and the source of fund. Source of fund can be from the borrowing, right? So bank need to have backup, which is backup from the capital, a lot of capital, so they can use this capital anytime to fulfill the short-term liability obligations. Okay, and another things, more capital for the bank that operate in high risk. The operational is high risk. For example, when they have a new system, okay, so when they just starting online business, online banking, okay, or they hire expertise, okay, so pay so much on the system for their security. So this system sometimes they need to maintenance, and then maybe they need to uh, to buy a new system. So if they have problem with operational risk, when dealing with other branch, okay, they need to have more capitals, okay, because to cover the risk from the operationals, okay. So the minimum capital requirement are setting by the central bank based on the certain category, okay. However, when a bank need to fulfill the capital requirements, actually there is a pro and cons. The pro is, of course, the capital requirement is good to ensure that bank can limit their risk to fail, limit their loss, to ensure the public confidence. However, the capital requirement setting by the supervisor of the bank can limit the ability of the bank to grow. Okay, how? How the capital requirements, this compulsory capital requirement to fulfill by any banks under the central banks can restrict the ability to grow. Okay, so there is impact of capital requirements. For example, uh, limiting asset to grow. How? Okay, this is because when a bank, they have capitals, but this capital they need to maintain as minimum capital requirement. So they cannot use this capital to lend the money to the borrower. So when they cannot lend money using this capital to lend the money to the borrower, okay, meaning they can limit the asset to grow. Okay, they limit the fund to lend to the borrower. Okay, so this can affect the bank income. Okay, they have money, but they need to keep as a capital requirements. Okay, number two, okay, is the impact on changing asset composition. Okay, from time to time, the capital requirement are setting differently. Maybe there is a So due setting differently, maybe 9%, 8%, due to some maybe increased capital requirement, at least all banks should have 10% capitals requirement to fulfill the capital requirements. So the changes of capital requirement will affect also the changes of asset composition. For example, if the capital requirement need to this year is 8%, okay, so bank have more capitals, okay, they can lend the money to the borrower. But suddenly bank change the capital requirement at 10%, meaning bank need to reduce, okay, their asset from the long-term long-term loans to the short-term loans, okay, so they can get back their money fast to fulfill the requirement of capitals setting by the central banks, okay. So changing asset composition, for example, from short-term to long-terms, okay, from the household to business, okay, the changings, okay, type of loans. And then it also can, when they affect changing of asset composition, it can also affect the income. Long-term loan are higher income compared to the short-term loans, okay. And then the capital requirement also will affect the pricing policy. Changes of pricing policy, increase or decrease of the interest rate setting by the bank to the borrower, to the depositor. Because um, when bank have capital and they need to keep the capitals in the banks, okay, they have short of fund, okay, to lend to the borrower. So what they need to do to fulfill the borrower demand of loans, maybe they can borrow money from outside, from other bank, from other sources, okay. When they borrow money from other sources, meaning the cost of funds are higher. So the cost of funds are higher, they will charge the borrower because the borrower borrow money from the bank and bank using money from borrowing from others. So the cost of fund is higher. So they will affect the interest rate the bank charge to the borrower higher. Okay. And then the next is shrinking the size. Okay. How the capital requirement will affect the size of the banks. Okay. So due to bank need to fulfill the capital requirement. Okay. So the bigger the bank, they need to put uh, more money, okay, to ensure they have more capital requirements, okay. So due to fulfill the capital requirement, what bank can do is they reduce their assets, okay. Because it's so because of the small, especially for the small banks, okay, they have limited sources, okay, they limited sources to fulfill the a small bank. When they issue share, for example, when they issue bonds, okay, their sometimes cannot be fully subscribed when they issue bond or when they issue share, okay. So they have limitation to access capital from the external financing, okay. So when they have difficult to access capital from the external financing, so they will limit their ability to gain more capitals. So due to that, it will affect the bank operate in the small capital only and to fulfill the capital requirement. Okay, when they have small capital requirement, small capitals, then they use for the capital requirement. It can affect uh, how uh, the loans, the amount of loan they can lend to the borrower. Okay, they should reduce the amount on loans because to ensure it covered by their capital requirement. So this can reduce the size of the bank. Okay, become smaller when the bank cannot access the external source of financing, when they cannot issue share, when they cannot issue bond. Okay. That's how capital requirement affects the bank shrinking their size. Okay. Okay, so how bank fulfill the capital requirement? Okay, how bank check whether they have adequate level of capital. So basically, when bank want to check whether they have adequate level of capitals, they will fulfill the BNM capital requirement. Okay, so they can check based on several ratio. For the investor, when they want to check whether bank have adequate level of capital or not, they will check on the several type of capital ratio. For example, capital to deposit ratio. Okay, how much capital to deposit ratio? Because to ensure that um, the bank capital can fulfill the withdrawal demands. Okay, and then capital to total assets. Okay, so this one, capital to total asset ratio, to ensure that banks have capital to lend the money. Okay, and then capital to risk weighted asset ratio. They check the capital based on type of risk. Okay, and then lastly, capital to loan ratio. Okay, this one to ensure that that capital can cover the credit risk. That's why they check capital to loan ratio. So the higher the loan, meaning capital should be higher. Okay, so central bank have their own capital adequacy framework. Okay, for commercial bank, for Islamic bank, and development financial institution. You can check. Okay, on the next slides. Okay. Okay, basically when we compare uh, the capital requirement framework setting by the uh, setting by the central banks. Okay, when they you check on that. Okay, basically central bank the settings the um, capital requirement framework based on the Basel 1, Basel 2, Basel 3. Okay, based on the world decision. Okay, bank world. Okay, so most of the capital requirement are similar amongst commercial bank and Islamic banks, and a little bit different for the DFI because DFI are managed by or developed by the government. So they have their own uh, different way, okay, of the capital requirement. So you can see, basically we focus on this one. Okay, you doesn't need to memorize, only you need to know how they checks. Okay, number one is based on tier one, the common equity like shareholder. Okay, they need more to have more than 4.5%. Okay, and basically the overall total capital adequacy ratio. Okay, minimum capital adequacy ratio, minimum requirement. Okay, at least bank should have more than 8%. Okay, with 2.5 is buffering. Okay, so this is how they calculate. Okay, to calculate tier 1 to ensure that fulfill the tier 1 ratio and total capital ratio. Okay, you can see total capital, how they calculate total capitals. All capital, tier 1 and tier 2, minus the adjusted for tier 2 capitals. Or they also can calculate the total capital ratio using the total capital divided by risk weighted asset. Okay, risk weighted asset. RWA is risk weighted assets. Okay. So you can just read the rest of the slide for your knowledge. Okay. For example, this one, even though bank have capital requirement 8%, but they need to have buffering 2.5, meaning at least around 10.5% of capitals. Okay, until now. Okay, and you can check here. Okay, this is the I think last year. Okay, our capital total capital ratio is 8%. Okay, but this is based on Bank Negara Malaysia. Most our banks, okay, their average are higher than that, even higher than plus buffering. Okay, actually the minimum is 10.5, but they have more than that. Okay, you can see mostly bank in Malaysia, all the capital adequacy ratio, they fulfill the requirement of capital adequacy ratio and quite high based on the minimum capital requirement, because if they have more capital ratio, meaning they can lend more. They are very strong to lend more because they have more capital to absorb the loss. So bank, negara Malaysia allow them to lend the money more to the borrower. So when they can lend more, meaning they can generate income more. Okay. Okay, this also basically the capital setting by the bank are actually from the World Banks, because we also involved in the decision of World Banks. Is setting by Basel. We have Basel 1, Basel 2, Basel 3. Basel, what is Basel? Basel is the place in Switzerland when all the bank player in a country, okay, central banks for each country, they're meeting at the Basel, Switzerland, and they discuss about how to strengthen the capital of the banks. Okay, so starting from Basel 1, the reason they're setting the capital requirement in the first meeting, okay, 1988, but the enforcement to implement the capital requirement is January 1993. On this, they only consider about the credit risk. Okay, due to the credit risk, banks should have certain level of capitals. Okay, so however, even though they have setting the capital requirement due to the credit risk, and then in 1997 there is a financial crisis. Okay, 1997, 1998 Asian financial crisis. A lot of banks collapsed. Okay, due to the don't have enough capitals, do not have adequate capitals. So they meeting again and they're improving. Okay, they're setting the capital requirements. Okay, when they're setting the capital requirement, they not only consider that capital requirement due to the credit risk, but also operational risk. Okay, they need to consider how bank operate their asset and liability, how bank manage their asset and liability mismatch. Due to this risk and credit risk, they're setting the capital requirement in Basel II. Okay, perhaps in the future when economic crisis, there is no more bank collapse. Okay. However, again, in 27 in 2007, in 2008, there is a real property crisis, and a lot of banks in UK and US affected due to this crisis. Okay, even though they're setting a good capital requirement in Basel II, it's showing that that's capital requirement still not strengthen the capital of the banks, meaning that not adequate. Okay, so they do meeting again to implement Basel III. Okay, most of the bank currently now to fulfill the requirement Basel III, the requirement of Basel III. Okay, so Basel III, they setting the capital requirement, how much bank should have, and the calculation what type of capital, all of that, based on three risks, not credit risk, operational risk, and also liquidity risk. Okay, they consider more on liquidity risk, the type of liquidity when they're setting the capital requirement for each bank. Okay, so the reason to ensure the reason when they're setting Basel III is no more problem when or bank can face the any financial crisis in the future. So therefore, by consider all the risks, almost all the risks, credit risk, operational risk, and liquidity risk, very important, because anytime bank can have liquid funds. Okay, to ensure the bank can absorb any economic crisis. Okay, any financial crisis, so that they can improve their risk management and also transparency when they disclose about their financial conditions. Okay, so the conclusion is, in managing the banks which have risk, to manage the risk of the bank, they need to consider how to manage a good capital, bank needs to have a adequate level of capital so they can secure their security. Okay. Okay, the rest of the slide is about case study on Maybank. You can check how Maybank develop their capital adequacy framework to fulfill the requirement of central banks. Okay, they have their own framework and they have their own internal assessment for the capital adequacy to ensure that they are always fulfill the requirement of central banks. One of the plan to ensure they have adequate level of capitals, they also have program dividend reinvestment scheme, meaning when they uh, distribute dividends to the shareholder can reinvest back. Okay, meaning they can, rather than they take cash, okay, they keep more in the bank. So bank can use that as undivided profit to reinvest as a capital of the bank for their operations. Okay, so that's all. Perhaps you can see the rest of the slide about the banks. Okay.